Hey everyone, welcome back. You know how much we love diving deep into your investment questions, and this one is a hot topic, dividend investing.
Yeah, it really is.
You sent over this really interesting article titled, Dividend Investing, Are the Returns Worth the Hype? And I got to say, the title alone got me hooked.
Makes sense. There's so much buzz around dividends, but you really have to peel back the layers.
Like, is it a solid strategy, or are we all just getting swept up in the hype? That's what we're going to figure out today. The article starts by defining dividend investing, which sounds pretty straightforward. You're basically focusing your portfolio on assets that pay out regular dividends. But why do companies even bother with dividends in the first place? Wouldn't it make more sense for them to, just reinvest all their profits back into the business?
That's a smart question. It all comes down to how companies decide to use their profits. You see, when a company's doing well, generating those nice, consistent profits, they've got a choice. Plow it all back into the business or share some of that wealth with their shareholders.
Okay, so dividends are like a reward for sticking with them.
Exactly. It's a way to show appreciation to investors, encourage them to hold on to the stock, and maybe even attract new investors.
And that's where this whole dividend yield thing comes in, right? The article compares it to like the interest you'd earn on a savings account, but instead of a bank, it's tied to how well the company's doing. That's got to be a big part of why people get excited about dividend investing.
Yeah.
It's like this promise of like regular income.
Absolutely, especially for investors who are looking for a consistent stream of cash flow.
Right, right. Like imagine you're retired. You're not pulling in a regular paycheck anymore. Having those dividends coming in regularly, that can make a huge difference.
Yeah, it could really provide a sense of financial security. But here's where things get even more interesting. The article hints that dividends can actually boost portfolio growth, too. It mentions this whole concept of reinvesting dividends to create like a compounding effect.
I was hoping you'd bring that up because honestly, when I first read that part, my brain kind of went, huh. So break it down for me. How does reinvesting dividends actually help your portfolio grow faster?
Think of it like a snowball rolling downhill. It starts small, but as it rolls, it picks up more and more snow, getting bigger and bigger.
Okay, I'm starting to see the analogy here. So the snowball is like your initial investment, and the snow it picks up along the way. That's the dividends.
Exactly. When you reinvest those dividends, you're basically buying more shares of the company. And those new shares generate even more dividends, which you can then reinvest to buy even more shares, and so on and so on.
So it's like this beautiful cycle of growth fueled by those dividends. But even with all this talk about potential rewards, the article also injects a dose of reality. It warns the dividends, well, they aren't exactly a guaranteed path to riches. There are risks involved, right?
Oh, absolutely. No investment is completely risk-free. And with dividends, the biggest risk is that companies can decide to cut or even eliminate those payments altogether.
So even if a company has this long history of paying dividends, there's no absolute guarantee they'll keep doing it. That seems a little unsettling.
It's true. Remember, dividends aren't like a contractual obligation. They're a decision that the company makes based on its financial health, its future prospects, and a bunch of other factors.
Okay, that makes sense. So it's not just about chasing the highest dividend yield, right?
Yeah.
You really have to look deeper than that. But how do you actually go about finding companies with that solid track record of paying dividends, but even more importantly, companies that are likely to keep those dividends coming in the future?
That's where good research and due diligence come in. Think about it.
Right.
You wouldn't just buy any stock just because it has a high dividend yield. You want to understand the company's business model.
Right. What's the competitive landscape? Who's running the show? The management team? And of course, how healthy are their financials?
Exactly. It's about getting a complete picture.
It sounds like the key takeaway here is to look beyond the hype. It's not just about those juicy dividend payouts. It's about finding companies that can sustain those payouts over the long run. But I'm curious, are there certain types of companies or industries that are like known for being more reliable dividend payers?
Yeah, there definitely are. For example, mature industries, those with stable earnings like utilities or consumer staples, they've often got a history of pretty consistent dividend payments.
Because they tend to generate those like predictable cash flows, make them more likely to share the profits with shareholders.
You got it. But even then, you still got to do your homework.
Always do your homework. So it's not just about finding companies that pay dividends. It's about finding companies that are like built to keep those dividends flowing.
Right. And ideally, even grow those dividends over time.
That's where this dividend growth concept comes in, right?
You bet. Dividend growth investing. It's like taking dividend investing to the next level. It's not enough to find companies that pay dividends. You want those companies that are consistently raising those payouts year after year.
Okay, so you're looking for companies that are not only sharing their profits, but they're actually growing those profits,
Yeah.
which allows them to share even more with investors down the road.
That's the idea. And companies that can pull that off, consistently raise their dividends, it's often a sign that they're in good financial shape.
It sounds like dividend growth investing could be a really powerful way to build wealth over time, especially if those dividends are compounding and the companies are like steadily upping their game with those payouts. But I have a feeling it's not as simple as just finding companies with a history of raising dividends, right? There's got to be more to it.
You're right. It's not just about looking at that dividend growth rate in isolation. You need to dig into the company's fundamentals, see what's really driving that growth.
So what kind of homework should investors be doing here? What are the key things to look for?
You want to examine their earnings growth. How much debt are they carrying? What's their competitive position in the market? And of course, their overall financial health. Just because a company's been increasing its dividend for, say, the past 5 or 10 years doesn't guarantee they can keep doing it forever.
Yeah, things change. So even with dividend growth investing, thorough research and due diligence are still key.
Absolutely. You want to make sure that dividend growth is sustainable. You're not looking for companies that are, playing financial games or taking on mountains of debt just to boost those payouts. You want the real deal. Companies that are genuinely growing their earnings and cash flow, which gives them the muscle to support those dividend increases over the long haul.
I'm really starting to see how dividend investing, whether it's focused on yield or growth, requires a more active approach than I initially thought. It's not a set it and forget it kind of strategy. You got to stay informed, monitor your investments, and make sure those companies are still on the right track to deliver those consistent and growing dividends.
Couldn't agree more. It's an ongoing process of research, evaluation, and adjustment. But hey, that's what makes investing so engaging, right?
True. But remember, the article also points out that dividend investing isn't the only game in town. It mentions other investment avenues like growth stocks, bonds, and REITs.
Oh, yeah. Those are all worth exploring.
And it would be great to understand, what are the main differences between these approaches?
Yeah.
And when might they be, a better fit for certain investors?
Absolutely. That's something we should definitely unpack. Because at the end of the day, there's no one right way to invest. It all depends on your individual situation, your goals, and how much risk you're comfortable taking on.
Okay, so we've talked a lot about what dividend investing is, why companies might choose to pay them, and some of the potential pitfalls to watch out for. But the big question still remains. Are the returns really worth all the hype? I'm super curious to dive into that.
Me too. To really answer that, we need to dig a little deeper into the potential rewards and see how they stack up against those other investment strategies. It's going to be an interesting discussion.
I'm ready to dig in. I'm starting to see how dividends could be a valuable part of, a well-rounded investment portfolio. But I'm also eager to explore those alternatives and see how they compare. Let's get to it.
Okay, so we've laid the groundwork. Dividend investing isn't just about chasing those high yields. It's about finding those companies that can consistently share their profits with us investors. But how does this strategy actually stack up against other approaches? What about growth investing? How do they compare?
That's what I'm wondering. The article mentions that dividend-paying stocks, historically, they've done pretty well, delivering some solid returns. But is that always the case? And how do they compare to, those high-growth companies that everyone's buzzing about these days?
That's where things get a little more nuanced. Historically speaking, dividend-paying stocks have often been a bit less volatile compared to growth stocks.
Less volatile. So you're saying they tend to fluctuate less. Less of a roller coaster ride for my portfolio.
Exactly. Their prices tend to be more stable, which can be really appealing, especially if you're someone who prioritizes, capital preservation. You don't want to see those huge swings.
That makes sense, especially if you're nearing retirement or if you're relying on your investments for income. You want to be losing sleep over every little market dip. But I got to ask, doesn't that lower volatility also mean potentially lower returns? I mean, growth stocks, they have this reputation for, skyrocketing in value, right?
True. Growth stocks do have the potential to deliver those really impressive returns, but it's important to remember that higher potential rewards, they often come with higher risks. Think about it. Growth companies, they're typically investing a lot of their resources into research and development, expansion, trying to innovate and grab market share.
So unlike those dividend-paying companies, They're probably not as focused on sharing profits with investors in the form of dividends because they're like plowing everything back into the business to fuel that growth.
Precisely. It's a different mindset. With growth stocks, investors are essentially betting on the company's future potential, hoping that the stock price will soar as the company expands and its earnings take off.
Okay, so it sounds like it's a trade-off. You're choosing between like the potential for rapid growth and the stability of those consistent dividend payments.
It probably boils down to like your individual investment goals and how much risk you're willing to stomach.
You nailed it. There's no single right answer. If you're younger, you've got more time on your side, and you're okay with a bit more risk, then maybe you allocate more of your portfolio towards growth stocks.
Makes sense. You can ride out those ups and downs a little easier when you're not planning to tap into those investments for a while. Right. But if you're, let's say, nearing retirement or looking for a more conservative approach, well, dividend-paying stocks might be a better fit for your overall strategy.
The article also talks about this whole concept of dividend growth investing, which sounds pretty intriguing. Is that just another way of saying dividend investing, or is there something more to it?
Dividend growth investing, it takes the concept of dividend investing and like amplifies it. It's not just about finding companies that pay dividends. It's about those companies that consistently increase their dividend payouts year after year.
So you're not just looking for companies that are sharing profits. You're looking for the ones that are growing those profits year after year, allowing them to share even more down the line.
Exactly. It's like finding those all-star companies that are committed to rewarding their shareholders with bigger and bigger slices of the pie over time.
Companies that can consistently raise those dividends, that's got to be a good sign, right? It suggests they're doing well financially and their management team is, prioritizing returning value to their shareholders.
Right. But remember, it's not just about chasing the highest dividend growth rate. You got to dig deeper and really understand what's driving that growth.
So beyond just looking at how much the dividend is increased, what other factors should investors be paying attention to? What are those key fundamentals?
You want to look at their earnings growth. Are they making more money year after year? How about their debt levels? Are they managing their debt responsibly? And then there's their competitive landscape. Are they a leader in their industry? Do they have a sustainable advantage? And of course, always check their overall financial health. Just because a company has a history of increasing its dividend doesn't mean that trend will continue forever,
Right. So even with dividend growth investing, research, and due diligence, that's still the name of the game.
It always is. You've got to make sure that dividend growth is sustainable. It shouldn't be based on like gimmicks or taking on risky levels of debt. You want companies that are truly growing their earnings and cash flow, which allows them to comfortably support those dividend increases over time.
Man, I'm realizing that dividend investing, whether we're talking about yield or growth, it's not passive at all. You can't just like set it and forget it. You got to stay on top of things, keep an eye on your investments, and make sure those companies are still in a good position to deliver those consistent and hopefully growing dividends.
Exactly. It's an active process. But that's part of what makes it so rewarding, I think.
I see that.
Yeah.
But hey, let's not forget, the article was also clear that dividend investing isn't the only path out there. It mentions other investment options like growth stocks, bonds, and REITs.
Right. We talked about growth stocks earlier, but those other options, they're worth exploring too.
Yeah, I'd love to learn more about those. Like, what are the key differences between these approaches? And when might they be, a better fit for certain investors?
Great question. I think it's important to emphasize that no single investment strategy is inherently better than another. It really comes down to your individual circumstances, your goals, and of course, your risk tolerance.
Okay, so let's break down each of these alternatives. First up, growth stocks. We touched on them earlier, but I'd love to dig a little deeper. These are the companies that are like constantly making headlines, right? They're known for their rapid expansion, those innovative products or services that are changing the game.
Think tech companies, biotech, those emerging industries that are, disrupting the status quo. These companies are typically plowing most of their profits back into research and development, marketing and expansion, anything to fuel that rapid growth.
So they're less likely to be sharing those profits with investors in the form of dividends because they're using that money to, grow the business as quickly as possible.
Exactly. Their focus is on maximizing future potential, not necessarily on current profitability. Investors in growth stocks are essentially betting that the company's stock price will skyrocket as its revenue and earnings take off.
But, like we discussed before, they could be pretty volatile, right? Growth stock prices, they can swing wildly depending on Well, pretty much anything. Market sentiment, news headlines, whether the company meets those growth expectations.
It's a riskier game for sure. Growth investing is definitely more suitable for investors who have a higher risk tolerance and a longer time horizon. They're basically saying, I'm willing to ride out those ups and downs for the chance to potentially hit it big down the road.
Okay, so growth stocks, higher risk, higher potential reward. Got that. Now, what about bonds? Those seem like a completely different beast compared to stocks. Like, how do those work?
They are pretty different. Bonds are essentially loans that you make to either a government or a corporation. So when you buy a bond, you're lending money to that issuer for a set period of time. And in return, they promise to pay you a fixed interest rate, which is called the coupon rate, and then they'll repay the principal amount when the bond matures, reaches the end of its term.
Okay, so unlike stocks, which represent ownership in a company, bonds are more like you become a creditor. You're lending money, not buying a piece of the company.
Exactly. And because bonds have that fixed interest rate and a defined maturity date, they're generally considered less risky than stocks. They offer a more predictable income stream, and they're not as susceptible to those wild market swings.
So for those investors who are like really prioritizing stability and income, bonds can be a really attractive option, right?
Yeah.
Especially for those who are approaching retirement or those who are just looking for a less risky way to generate some income from their portfolio.
You got it. Bonds can offer that steady stream of income that some investors really crave, and they can also help to balance out the volatility of stocks in a diversified portfolio, not putting all your eggs in one basket and all that.
Diversification, always a good idea. And last but not least, what about REITs? The article mentioned those as another alternative to dividend-paying stocks. I'm not even sure how to pronounce that. Are we saying REITs?
Yep, REITs. Stands for Real Estate Investment Trusts. Basically, these are companies that own, operate, or finance income-producing real estate.
So instead of me buying a rental property or investing in like a commercial building directly, I could buy shares in a REIT that owns and manages those properties.
That's the idea. And REITs are actually required to distribute at least 90% of their taxable income to shareholders in the form of dividends. It's kind of built into their structure.
So if you're an income-seeking investor, that's got to be pretty appealing, right? Getting a piece of those rental income streams or those profits from commercial properties?
It can be. REITs often have higher dividend yields compared to a lot of traditional stocks. Plus, they give you a way to diversify your portfolio beyond just stocks and bonds. You're adding some exposure to the real estate market.
That's smart. So, okay, we've got growth stocks, which are all about the potential for big returns but come with more risk. Then we've got bonds, which are like the steady eddies, offering more predictable income and less volatility. And then there are REITs, which give us a way to tap into the real estate market and potentially snag some juicy dividends along the way.
Right. Each of these options has its own unique characteristics and potential benefits, and of course its own risks, too.
And I guess the trick is figuring out which one or which combination aligns best with your individual needs and goals, right?
Exactly. There's no one-size-fits-all answer in investing. The best approach really depends on your specific situation, your risk tolerance, your time horizon. It's very personal.
Which is why it can feel so overwhelming sometimes. Like, where do you even begin?
That's where seeking advice from a financial advisor can be incredibly valuable. They can help you assess your risk tolerance, clarify your goals, and develop a personalized investment strategy that's, tailored to you.
That's a great point. A financial advisor can, help you cut through all the noise and make sense of all these options. It's always wise to have an expert in your corner, especially when it comes to making those big financial decisions.
I totally agree. They can provide that guidance and expertise that can really make a difference.
Okay, so we've covered a ton of ground in this deep dive. We've really explored dividend investing from all angles. The good, the bad, and the complicated. And we've even delved into some really interesting alternatives like growth stocks, bonds, and REITs. But I gotta say, that initial question that sparked this whole conversation, it's still lingering in my mind. Are dividend returns truly worth all the hype? What's the final verdict?
That's the million-dollar question, isn't it? Let's bring it all together, recap what we've learned, and see if we can answer that definitively. It's time for the grand finale.
Okay, so let's recap everything we've learned today and finally answer that big question. Are dividend returns really worth all the hype? I'm feeling a bit more, informed, but honestly, a lot more uncertain too.
I think that's pretty natural. It's easy to get swept up in, the excitement around any investment strategy, but like we've seen, it's never that simple. There's always more to consider. Dividend investing, yeah, it can be powerful, but it's definitely not some magic bullet.
For sure. We learned that dividend-paying companies, they can provide that steady stream of income. And that's really attractive, especially for investors who are looking for that reliable cash flow, retirees or folks who are looking to supplement their income.
Right. And we talked about the potential for dividend growth to really boost returns over time. Finding companies that consistently increase their dividend payouts, that's where things can get really exciting, especially when you're reinvesting those dividends and letting that compounding effect work its magic.
But then we also talked about the risks involved, right? Companies can run into challenges, their profits can take a hit, and sometimes those dividends get cut or even disappear completely. It's definitely not as simple as just picking a stock with a high yield and calling it a day.
Nope, not at all. That's why, like we said over and over again, thorough research is so important. Understanding the company, its financials, its competitive landscape, its track record with dividend payments, all of that's essential before you make any decisions.
And we also spent some time, comparing dividend investing to those other strategies, growth stocks, bonds, REITs. It seems like each approach has its own personality, I guess you could say. Each one comes with its own risks and potential rewards.
Yeah, there's no one perfect strategy that fits everyone. It really depends on your goals as an investor, your risk tolerance, how long you're planning to invest. It's very individual.
So after everything we've discussed, can we definitively answer the question? Are dividend returns worth the hype?
I think the answer is, well, it depends. Dividend investing, yeah, it can be a great strategy. It can really help you build wealth and generate income. But it has to be approached with a cautious mindset and a focus on those companies that are built for the long haul.
It depends. I love that. Because that's what makes investing so, both challenging and exciting. There's no magic formula. It's all about making smart decisions based on your personal circumstances and, what you want to achieve with your money.
Absolutely. And that's why, staying curious and continuing to learn is so important. The world of finance, it's always changing. Staying informed, being willing to adapt, and never stopping learning, well, that's how you set yourself up for success over the long term.
And even though this deep dive into dividend investing is coming to an end, your exploration definitely doesn't have to stop here. You've got the knowledge, you've got the tools. Now you can start digging deeper, researching specific companies, exploring different sectors, and really figuring out what works best for you.
That's the spirit. Keep learning. And as you continue on that journey, I'll leave you with one final thought. Beyond just looking at the numbers, the financials and the dividend yields, what are those intangible things that you value in a company? What kinds of businesses do you really want to support with your investments?
That's a fantastic question to ponder. Because at the end of the day, investing isn't just about, maximizing returns. It's about aligning your financial decisions with your values. Keep exploring, keep asking questions, and keep learning. Until next time, happy investing.